Welcome back, and today what we're going to do is we're going to be producing a series of videos that are going to be outlining the impending financial crisis that the world is going to be facing in the very near future. Obviously I can't predict exactly when, but I think there are plenty of signals in the global economy that will justify what my thesis is. Now, what we're going to do is we're going to look at in this series of videos, we're going to look at the three economic groups of the US, the European Union, including the United Kingdom, and China. Now, the reason we're doing this is because the US, China, and the European community are all in a process currently of collapse, but they're just collapsing a bit differently. And the reason why they're collapsing differently is because they have, for example, the United States and all countries in the European Union, the European bloc, are democracies, and also they have there's fundamental, whereas China is not a democracy, and basically we have a much stronger financial and cultural relationship between the United States and Europe, and also greater systemic banking and financial links than what there is between the United States and China and Europe and China. Although there are links, they are not as significant as the Euro-US alliance. But China does have problems, and those problems are more internal, and I'm going to go over these things more as the video progresses. Now, what we're going to do is we're going to be covering the respective triggers in each economy or in each economic zone. And then we are going to be looking at a final video, potentially the fourth video, which puts all the pieces together and relates them, and how that will affect ultimately the strategies that you make for your investment portfolio. So let's actually start with the global picture at the moment, because we can't look at China, US, the European bloc in isolation of the global economy, because each one of them does affect to some extent the global economy. So my concern, as we have seen in the previous videos, is that we have a major debt overhang, a global debt, and the global debt is close to 250 trillion as of the end of 2018, and that's the World Bank IMF figures. And also what we have is, when we start to put that in context with what the global GDP is, the global GDP is $75 trillion. Now, that means that we have a multiple of 3.3 of GDP to global debt. But if we actually look at the GDP, we can actually see how this GDP is also broken up into the various regions. We can see that the United States is about 25% of the world GDP, and that's followed next by China, and then we can see a whole amalgam of European countries together. And what we do have as well in this particular graphic is to show that even though we're concentrating on the three main economic zones, what we're looking at as well is the fourth entity, which is the combination of all the other countries like Australia, New Zealand, other BRICS countries, etc. So basically, what we're looking at is a total picture, and 3.3 times GDP is a frightening figure. Now, if we look at the world debt in its context to percentage of GDP, we're looking at close to 330%, 320%. Let me put this in perspective. If you have a global debt to GDP ratio of 320% and you don't have a problem, you have to think back to the Greek crisis, where the GDP to debt is, and in most European countries, is much less. But yet we have a global GDP to debt of close to over 300%. So this is in itself a matter of concern for the global economy. And we can see from the other side of the graphic as well that we have seen a very steep increase in the attainment of global debt since basically 2000. In 2000 we had, I think it was about 84 trillion in debt. By 2008 this had risen to 173 trillion, and currently we're on 250 trillion. But of major concern as going forward in this global context is also what I call the hidden debt, which is contingent liabilities. And we've also seen from a study from the World Economic Forum that if we add in, say for example, we've got 150 trillion of contingent liabilities, which makes a total figure of 400 trillion. And that's when we add in India and China and all these other countries. And one of the major problems going forward, which is not necessarily a problem at the moment, but it's a problem at the moment in terms of funding, is that the populations, and many of the populations in Europe, say for example Italy and Germany, are on a declining basis. So therefore the demographics are not looking good. And China, certainly with the one-child policy, the demographics aren't looking good for future future ability to meet these contingent liabilities, because the debt burden is falling on a diminishing younger population. So that doesn't bode well for the future. Now, let's start looking at the problems of the United States. With the United States, we have a debt that's pretty well close to 22 trillion now, and that is a major issue. The debt is not going down, it's not being under control. This year it went up by 1.3 trillion. 800 billion of that was, in inverted commas, national debt per se that we're normally used to. 500 billion of that was extraordinary items like disaster relief, and 500 billion added on to the national debt is still quite a hefty amount. Now, we have another major concern, as I said, goes back to many of my videos before, is the corporate bond market. The corporate bond market has exploded in terms of volume, and it's now, according to the Fed, especially St. Louis Fed, it's 9.6 trillion, dollars. What's of concern of this is not necessarily, well, the concern is the size of this debt, but the major concern is the size of the junk bond aspect of this debt, and we're talking about 40% of it. And that equates to about 5.5 trillion. And as we've seen the interest rates go up under Powell's anchorage at the Fed, we've seen basically a hissy fit as far as many of these corporates are concerned, and we've started to see problems where some corporations have gone to junk bond status, down to BBB. And so this situation is not going to get any better as the interest rates start to squeeze, because think about it. If you have companies that have been not performing very efficiently but have had access to cheap capital, they're going to use that capital to buy back shares, increase their PE ratios, and then basically what they're going to be able to do is what they're not going to be able to do is to invest in infrastructure. So basically they've been chewing up capital and not investing. So this is a major worry, and this is one of the problems that's happened in Europe, but I'll go into that in the next video, which is very important going forward. So we're starting to see substitution of capital, working capital being eaten basically from within, and that doesn't bode well for the companies that are BBB+. So we're going to see not just a lot of fallen angels, but we're going to see a lot of company collapses. Now, the other side of things is that when we also need to think about disaster planning when we talk about investments. And to a certain extent, the Fed has done a bit of disaster planning in terms of shoring up the balance sheets of the various banks and the requirements as far as Bank of International Settlements and the Basel III. But I still don't think that's enough, and you'll see why later on. I mean, for example, again, according to press release by the Fed, they have done basically a disaster analysis, and what it shows is with 10% unemployment and rising interest rates, the banking system will be exposed to about 578 billion worth of damage, really, collateral damage. Now, this doesn't sound a lot, but what we've got to realise is this in itself is an event equivalent to the size and even bigger than the Lehman's event, and so we could be looking at various banks going broke and the Fed having to be stepping in again. But the whole thing of my thesis is that, according to the next several videos, is this is all going to be happening at once. There's no escape from any zone in the global economy. So this is something to look out for. And the reason why I'm saying at 10%, is almost a ridiculous amount, is because when we look at Greece and we look at the European zone, I mean, Greece has got an unemployment problem of close to 25%, and it's under 25s, and Italy's not much better, and Spain's not much better. So the 10% side of things is probably not realistic, because in an economic crash, and we've seen back in 2008, unemployment levels did pretty well touch that. And it took a few years to get back to where we are today, if you believe the figures totally. So what we have in effect is a major concern. And also CNBC, they've basically pointed out to this. If you don't believe me, the market itself is starting to show red flags, basically, as far as this potential bubbling bond crisis is concerned. There was a recent article back in late 2018, I believe it was November 2018, by CNBC, saying that the biggest red flag is the corporate debt and to cash ratios. And why is this important? Because this cash is what you use to pay back debt. Now, back in 2008 crisis, this ratio was at 14, but currently in 2018 it's 12. Now what this means is that for every dollar of cash that a corporate has, they have got $8 of debt. So this is in itself a very alarming figure, because again, if the economy is strained in a bad way, then there's going to be much. First of all, their turnover is going to go down, and then their debt requirements are going to go up. So if they're in already junk bond status, how are they going to pay back those particular bonds? They're going to have cash flow problems. So this is a major concern. Now, again, in another later article, they mentioned that the CNBC did say that this was a bubble that was existent in the economy. So we can see the alone just from the corporate debt side of things, we have major problems. Now, also going forward in the United States, although things are looking, in inverted commas, reasonably good in the United States, there are areas of concern, especially regarding real estate, because the warmer, hot centres of, say, for example, the Bay Area of San Francisco, that's now looking very, very soft. There's less activity on that than there was, and prices have actually come down. And it's the same for New York, and it's the same for various hotspots in the United States. So we're seeing the top end of the market start to decline, and decline by as much as 10, 15, 20%. But this is not just in the United States. We've seen very large real estate declines in London over the summer, for example, of 10%. Sydney, 10, 15%. Vancouver, 10, 15%. Now just imagine, if you've got another 6 months or a year of another 15% on top of that, you have a 30% reduction on the highs. Now, if you borrowed $3 million for a typical house in the inner part of Sydney, for example, if you borrowed $3 million, then you're going to be $1 million underwater approximately, with a 30% decline. And this obviously leaves banks exposed. So what we're seeing is, we're seeing areas like the real estate market, we're seeing areas like the bond market, we're seeing areas, well, there are investments and investors in the stock market. We've seen the stock market decline, but my view has always been that the stock market, when it declines, is either cyclical or it's a symptom of other deeper things going on in the bond market, and particularly the debt market, which we've talked about. So what we're going to do now is we're going to look at the European theatre, which is of much greater concern to me going forward, because to me the European theatre is potentially that theatre which is going to bring the whole house of cards down, because not only do we have political instability, and where there's political instability there always follows financial instability, and the risks that banks have in exposure to sovereign bonds in the United States, which is another factor possibly affecting cash flows and banks, is absolutely out of this. It's just out of the main forecasters' vision at the moment. But it is something that has to be looked at. So I look forward to seeing you in the next video, and we'll go forward from there. Thank you for watching, and bye.